From the headquarters of Team Cowboy, coming to you all the way from Anderson, South Carolina, it's the Finance Cowboy Show, where we talk about why real estate is boss, how the average everyday person, whether you work a full-time job or maybe you're raising a family, can achieve wealth through real estate, and how the Joneses, you know, those people that you've been trying to keep up with, they're actually broke. And we're going to give you a new source of inspiration to look at for what real wealth looks like. We're going to walk you through how to find rental properties, how to analyze them, obtain funding, manage those properties, and ultimately scale your way to life-changing wealth. I'm your host, JD Sustar, and I went from being in over $100,000 in consumer debt when I graduated college to now being a multi-millionaire in just a few short years through real estate. And this show exists to teach you the principles, tips, and tricks that I used and still use today to build generational wealth through good money habits and real estate so that you can implement them into your life and experience the time and financial freedom that we all long so strongly for. So folks, let's get this party started. Welcome to the first ever Finance Cowboy call-in show on this lovely Tuesday afternoon, Valentine's Day. I hope everybody's got big plans scheduled for tonight with their spouse or significant other. If you don't, you better hop on it quick. But I'm super excited about this call-in show. Give me a shout. Again, the number is 209-1129. That's 864-209-1129. I don't know if anybody has checked out the real estate market lately. I was having a conversation with a couple of my partners, and we were looking specifically at vacation markets, because a lot of times when downturns happen, vacation markets usually get hit worse. And for some reason, we've noticed that these vacation markets haven't been hit as bad. And so it'll be interesting to see what happens in the coming months, to see if the Airbnb space gets hit pretty hard like we think it will, or if it's able to sustain, because they're going to bring interest rates down sooner than we are expecting. So this caller, hello, who do I have the pleasure of speaking with? And they hung up on me. Wow, this is why we're doing this first show, and it's only lasting about 15 minutes. So if you guys are on Instagram and you want to text in questions, you guys go ahead and send them. I will snag some questions off of Instagram as well while we are getting the phones working. So you got to start somewhere. And so here we are. So if you're on this, you get to be on the first question. You get to be on the first time. Hello, who do I have the pleasure of speaking with?
Hey, Mr. Cowboy, this is Paul.
What's up, Paul? Thanks for calling in.
I've been very interested in buying property. I've been following you for a while, but just kind of like what you were just talking about with the economy being so down, I'm a little apprehensive about buying. Can you give me some advice to kind of like eliminate my fears and to officially take the dive and buy my first property?
Yeah, definitely. For you guys watching on other social media platforms, Paul has been wanting to get into real estate, and he's a little concerned with current economic conditions. And, one of my thoughts on, should he buy now? What should you look for? What does that look like? And I think it's a great question because the media does a fantastic job of putting fear into us, right? They want to scare us. Recession, everything's doom and gloom. We got Chinese balloons flying everywhere. UFOs are getting shot down all over the place. The world's coming to an end, right? And when you see that stuff, you kind of want to back out and not do anything. You just want to hold on to as much money as you possibly can. That's how you feel inside. But those emotions can keep us from capitalizing on opportunities that are currently presenting themselves and are going to continue to present themselves. And so, yeah, we are in a rocky market. We are in a downturn where you got large companies laying people off. People are losing their jobs. Stock prices are down. But as an investor, this is when you look to thrive. This is when you can find those absolutely great deals that can totally change your life. And so we're starting to see, I was talking about the secondary home markets not long ago, and Paul, I'm gonna go ahead and answer your question and hang up. But we got the secondary home markets that we haven't really seen a hit yet, right? Those are the people who they probably got a little bit of money. It's their second home. They're doing a-okay, but other homes, like in the B to C class neighborhoods, they're starting to sit a little bit longer, right? So you're seeing homes sit on the market for 30 days, 40 days, 50 days. And not long ago, just a couple months ago, we had homes that were flying off the market in 2 days. If you guys remember, it'd be 1 or 2 days and houses were gone. And so, yes, while interest rates are up and the market's getting rocky, prices are starting to come down, right? Because the homes are sitting longer. And so when homes start to sit longer, obviously that means demand isn't as high, and the demand isn't as high mainly right now because of interest rates. But it's all a formula. And so if you're looking to invest, you have to look and say, okay, yeah, interest rates are a little bit higher right now, which are still not even ridiculous. When I started buying real estate in 2018, I was paying around 6% interest already. In the last two commercial DSCR loans that I've gotten were at 6.25%. So it's pretty darn close to where these rates were when I was buying, but you can't let rates scare you out of long-term wealth. And so, yeah, rates are going to be a little bit higher, but it's all a formula. And so when rates are up, okay, you got rent, purchase price, and rates. Let's look at those three things. When rates are up, well, that means we need to get the purchase price lower, or we need to get rents higher. Well, good thing for this market is rents are pretty stabilized, and they've actually continued to go up. I've renewed a couple leases recently, and we've done our standard price increase. But the beautiful thing in this market is because there is so much fear, and maybe because people made bad buys, prices are going to start going down. And you may not see those price drops today, but if you wait another month, month and a half, 2 months, and as we progress into 2023 and 2024, you will see those happen. And I'll tell you, as an investor, just because a home isn't listed at the price that you want to buy it at, if it could potentially be a good rental, doesn't mean that you can't pursue it. The last two properties that I purchased for rental properties, one of them I got for $30,000 less than what they were asking. And the second property I got for $40,000 less than they were asking. Now, a newbie rookie investor may look at that and say, well, these are way overpriced, because if you look at what they were asking, it was way overpriced. The numbers didn't make sense when you factored in interest rates and rents and maintenance, vacancy, all of that. There was nowhere close to cash flow, and it was going to be a terrible deal. But because these homes have been sitting, and I knew what the seller needed, which is key, we got to ask, what does this seller need to know what their motivation is to get rid of the property? I knew that they needed to get out. One of them, they were trying to move to a different state. The other was an estate who just was tired of holding on to the property. And because I had both of them, I was able to capitalize on two very, very good deals. And so we get these properties. I'd say both of them cash flow me, I don't know, $100 to $200 a month, which the cash flow is not life-changing. But because I got them at such a good deal, I have instant equity of somewhere between 40 and 50,000 each. So just call it 80 to 100 grand in equity. Boom, that I've made instantly. They've been repaired, so I don't have to worry about maintenance in theory. For a while. They're going to keep going up over time as they appreciate while tenants are paying down my debt. And then when interest rates do go down, guess what? What do you think I'll do? I'll refinance into the lower interest rate, which then, okay, is only going to shoot my cash flow up, because I'm going to be able to drop my payment when I go from, let's say, this 6.25 or 6.5% rate and drop back down into a 4.5 or 5% rate. So I would tell you guys, it's a formula, rent, purchase price, and interest rates. And so you really got to weigh all three of those. And hardly ever, this is the thing about real estate, is hardly ever are those three just in congruency. Every now and then you'll look and they're all three just firing on all cylinders. And that's when you can get fantastic deals. But generally, one of them's out of whack. Maybe interest rates are high, or like we've had in the past couple of years, interest rates were low, but prices were high. Or maybe, there's tons and tons and tons of people out of work and rent's got to come down. And so you're never really going to have all three. If you do, it doesn't last for a very long time, is my experience. And so don't let one part of the equation scare you from missing out on generational wealth. Your cash flow may not be as good as it could be, but it will one day. It will one day, as you continue to pay down the debt on that house, as rents continue to increase, and as rates continue to go down. Awesome, guys. Again, this is the first ever Finance Cowboy call-in show. The number is 864-209-1120. 829. We just had Paul call in and ask a great question. This will be recorded as a podcast. But if you want to watch this live and you want to be able to hear what callers are saying in our conversations, make sure you go to the YouTube link that I have pinned here on the call. And if you are on Instagram, TikTok, please send in questions. I see one right here that came through Instagram. How do you personally determine if a property is a good investment? What's your thought process? A great question, BK the Beautiful. There's some things that go into it, and I try to supply everybody with these resources. Number one, this is a loaded question. I mean, I'd spend a lot of time with, people in our mentorship and friends and buddies working on this a lot. So I'll try to give you a dumbed down answer, but you got to start with, where are we buying? That's key number one, is having that location. So where is our town or our city? And then even deeper than that, where is our neighborhoods within that town or city? So for me, you said personally, what is a good investment? I love single family homes in B to C class neighborhoods. Okay. So you got A, B, C, D class. A is going to be your luxury. D is going to be your war zone. B and C class are going to be somewhere in between. I love single family homes because it appeals to the masses. Banks love lending to single family homes, so it's easy to get loans for them. Tenants are usually better. I mean, think about the folks who want to live in a home compared to the folks who want to live in an apartment. Not that they're any better people, but most of the time it may be a family, or they're stabilized, or they got their roots settled. And so I really love it for that reason. And then exit strategy. If you're going to sell a multifamily property, who are you going to sell it to? You're going to have to sell it to another investor, most likely. You don't have just average Joe going out trying to buy a duplex, triplex, quadplex. Most people aren't, correct? Most people are trying to buy single family homes. And so when you're playing with, anything, any asset that's appealing to the masses, you're only going to help yourself. And so that's kind of my niche, B to C class. Not to say I won't deviate. I've owned mobile home parks. I've owned Airbnbs, but my bread and butter, single family B to C class. Okay. And then what I'm looking for is there's not like a specific, I have to have $300 in cash flow. I have to have 10% cash on cash return. For me, I am looking for those properties. I know if I buy in those areas, okay, I want to buy a distressed property in those areas. So my formula, usually if I'm buying a rental, is ARV, that's after repair value, times 80% minus the rehab, whatever amount I think I'm going to have to put in based on my inspections and my quotes from my contractors tells me what my purchase price needs to be. Again, I'm in those B to C class neighborhoods, single family home, after repair values. So I pull comps to find what the after repair values are. I go on Zillow and I look at recently sold homes that are very comparable to the one I'm looking at. Then I multiply that times 80%, subtract what I think I'm going to have to put in rehab, and that tells me what I want to purchase the property at. Okay. The way I come up with 80% is because my banks will do a cash out refinance at 80% of a new appraised value after I fix that property up. Okay. And that's a whole different a conversation for another day. But that's how I know, okay, if I can find a property and get it with that formula working, it's probably going to be a pretty good deal for me, because of what that is going to do. Is it's going to give me instant equity through the rehab. So forced appreciation is what we call it in the real estate world. Immediately that property is going to be worth more. And so I want to be able to add equity immediately. I got to be able to, because I'm doing the BRRRR strategy with private money. So I got to be able to pull that out through a bank loan and pay the private lender or hard money lender back. And then I'm looking for some form of cash flow. There's some deals where I'm looking for high cash flow. I bought a trailer park because I wanted a lot of cash flow, and the trailer park gave me a lot of cash flow. I bought an Airbnb because it pays me $850 a month. Okay, it's hard to find those right now with the market being like it is, but that was a couple years ago. But then there's other properties, my bread and butter, these single family homes in B2C class neighborhoods, that if I make $100, $150, $75, I even got some that break even every month, because I'm playing a long game here. Okay. Now cash flow is great. Don't get me wrong. And cash flow is something we should all strive for. And depending on your strategy, you may need more cash flow than the next person. I have a lot of income coming in. So for me to miss out on a property that's only paying me $150 in cash flow, but maybe the cash on cash return is infinity because I use private money. And so I was able to buy this asset using completely somebody else's money. Okay. Somebody else is going to pay it off for me. In a couple of years, it's going to be worth $250,000. You think I'm going to turn that down? You think I'm going to turn down $250,000 in equity 10 to 15 years from now because I don't like the $100 to $150 in cash flow now? I don't turn deals like that down because I'm not an idiot, right? I think long term. Do I wish the cash flow, every property would pay me $800 in cash flow a month? Absolutely. But they don't. And so that doesn't mean I skip out on them. When you play baseball, you just say, I don't hit singles. I only hit home runs. I only hit doubles. I only hit triples. No. What? Heck no. Like, take those deals, put them in your belt, say, hey, this is going to make me wealthy over time. And it happens pretty darn quick, guys. You know, you buy a property, maybe you have $40,000 equity in it this year. And then 5 years from now, you look, and between the tenant paying down your debt and appreciation and forced depreciation, now you have $100,000 in equity. Well, rents have gone up. So now you can go out and pull out $50,000 in equity in cash, pay yourself that $50,000 through a cash out refinance. You don't have to pay any taxes on that cash out refinance. Now you got a little bit bigger loan on the property, but the rents have gone up. So now the rents can cover that new loan, and you just paid yourself $50,000 in equity without paying any taxes. And you do that 2 or 3 times every year while you're adding 3 to 5 properties every year. Next thing you know, you're paying yourself $50,000 to $150,000 a year just in equity in your properties that you're not having to pay cash on. They got new notes, but now the tenants' rates are higher and they're still paying them off for you. That's the real game. People want to get on here and talk about cash flow. Cash flow is great. I'm not. You cannot get off here and say that JD said cash flow sucks. We all love cash flow, but don't let them fool you, folks. Don't let them fool you. The money, the wealth, the big dog wealth is made in buying low, distressed properties, fixing them up, and sitting on those bad boys and letting time and compound interest do its work, and it'll happen quick. I started in 2018, about a negative $10,000 net worth, and we surpassed over $2 million this year, all because of real estate, guys. It works, and it happens a lot faster than you think. Don't miss out on good deals over a couple $100 because you will kick yourself. Your future self will be very disappointed in you. I appreciate you guys joining this first call-in show. Thank you for bearing with me through the technology. I look forward to doing this moving forward, and this will be on all podcast platforms moving forward. So when it comes out, you have to check it out and share it for me on your stories and tag us so we can say thank you. But everybody have a happy, happy, happy Valentine's Day. Go spoil your significant other. If you don't have a significant other, go spoil yourself. Go get a bunch of sushi, manicure, pedicure, massage. Go live it up today. And I will see you guys next time, okay? Thanks. Thank you so much for listening in. If you love this episode, it would mean the world to me if you would share it with a friend right now, or if you would go on social media and make sure you tag me so I can thank you personally for helping me to get this message out. I want you to know that I am so darn grateful for you and grateful that I am on this journey with you. So until next time, we'll talk soon.